I want you to imagine for a moment that it's a quiet Sunday morning. You're sitting at your kitchen table with a cup of coffee. You've worked for 35 years. You've been disciplined, and you've built a retirement folder you've been contributing to since your early 40s. You open it and see your traditional 401k balance. Let's say it's $1.2 million. You feel relief. But here's what nobody tells you. That $1.2 million isn't entirely yours. It's a shared account with the IRS, and they haven't decided their final cut yet. If you're between the ages of 62 and 73, you're standing in what financial planners call the golden window. And if you don't use these 11 years to restructure your wealth, the government will do it for you on their terms. Here's why this window matters so much. For most people, these are the lowest income years of their adult life. The steady paycheck is gone, but required minimum distributions, RMDs, haven't started yet. That means your tax bracket is likely at its lowest point, and that creates a rare opportunity to move money from the IRS bucket into your own tax-free bucket at a discount. Because if you do nothing and leave that money in your 401k until age 73, you're walking straight into what's called the tax torpedo. At 73, the IRS doesn't ask what you need. They tell you what to withdraw. And those forced withdrawals, combined with Social Security, maybe a pension, can push you into higher tax brackets and even cause up to 85% of your Social Security to be taxed. It's a slow drain, and most people don't see it coming until it's too late. So how do you take back control? You use the golden window to do Roth conversions. You take a portion of your pre-tax money, say $40,000 a year, and move it into a Roth IRA. Yes, you pay some tax now, maybe 10% or 12%, but in return, that money and everything it grows into becomes tax-free. You're choosing to pay tax on the seed today, so you don't pay it on the harvest later. Let's make it real. Take someone like Robert. If Robert waits until 73, his required minimum distributions could push his income high enough to trigger IRLA, a Medicare surcharge that can significantly increase his premiums. And because IRMA looks back 2 years, a high-income year at 73 means higher costs at 75. But if Robert converts gradually during his 60s, he reduces the balance that drives those future withdrawals. The result? Lower income later, and no surprise surcharges. What he's really buying is flexibility, the ability to choose which account to draw from, depending on taxes. I've seen so many retirees follow the traditional path, saving everything in pre-tax accounts, only to find their retirement feels tighter than expected. They built a floor, but not an engine. If you're in this 11-year window, don't let the system decide for you. You can't control what happens in Washington, but you can control your next move. So here's one simple step. Open your retirement account. Look at the percentage in pre-tax accounts. If it's 90% or more, now you understand what that means for your future. Drop that number in the comments. Let's take a look together. And if you found this helpful, subscribe because there's a lot more coming. I'll see you in the next one.